Hello, and welcome back to Explain the Charts, your channel for in-depth technical analysis and market commentary. Today is October 18th, 2025, and we are diving deep into Bitcoin, or BTCUSD. The market is in a state of panic, with headlines calling this a free fall and a brutal crash, so we're going to break down the news and then hit the charts to see what's really going on. First, let's get a handle on the current events shaping this market sentiment. The news is overwhelmingly negative, painting a very grim short-term picture for crypto investors. Reports from Forbes and Fast Company highlight a massive sell-off that has wiped a staggering $600 billion from the total crypto market cap. Bitcoin itself has plunged below the key psychological level of $110,000, touching lows near $103,500 for the first time since June. This has triggered massive liquidations, with over $1 billion in leveraged long positions wiped out in just the last 24 hours, and a historic $19 billion liquidation event occurring just last week. Adding to the pressure, spot Bitcoin ETFs have seen their largest daily outflow since August, with over $530 million being pulled on Thursday. This suggests that institutional sentiment, which was a major driver of the summer rally, may be shifting bearish. Consequently, the Fear and Greed Index has plummeted to a yearly low of 22, indicating extreme fear in the market. Some analysts are now calling the top, suggesting the 2025 bull run peaked at the record high of just over $126,000 set back on October 6th. Now, let's switch to the charts and see how this news correlates with the price action. Looking at the full daily chart for BTCUSD, we can see the incredible run-up that began in late 2024. The price consolidated in the high $50,000 range in September 2024 before beginning a powerful ascent. We broke past previous all-time highs and saw an explosive move through November and December, carrying momentum into 2025. The price climbed steadily for months, setting higher highs and higher lows in a classic bull market structure. This multi-month rally culminated on October 6th, where we printed the current all-time high of $126,296. This level now stands as the most significant psychological and technical resistance for the bulls to overcome. Immediately after hitting this peak, we saw signs of weakness, with the price failing to hold gains and printing a bearish candle on October 7th. This was the first major warning sign that the incredible upward momentum was stalling. Then, the floor gave out. Let's zoom in on the price action since September to get a clearer view of this reversal. Here on October 10th, we see this massive, brutal red candle. This corresponds directly with the news of the historic $19 billion liquidation event. The price opened the day above $121,000 and flash crashed all the way down to a low of $103,310. This swift and violent move established a critical support level right around $103,000. Since that crash, the price attempted a recovery, climbing back toward the $116,000 level. However, it failed to find acceptance at these higher prices, showing significant selling pressure. The market has been bleeding out ever since, leading us to yesterday's candle, October 17th. This candle is incredibly telling. It shows a massive range, with a high near $116,500 and a low that precisely retested that critical support at $103,300. The fact that price spiked up so high only to be slammed back down and close near $106,000 is a very bearish sign, suggesting sellers are firmly in control and are selling into any strength. Now let's drill down to the 1-hour chart for the last 48 hours to dissect this recent volatility. Here we can see the price action that formed yesterday's huge daily candle. On October 16th, the price was already showing weakness, grinding down from $112,000 and breaking below the $110,000 support. The selling pressure intensified throughout the day, culminating in a sharp drop into the early hours of October 17th. This is where we see the price cascade down, breaking one support level after another until it finally found buyers right at that critical $103,300 level we identified on the daily chart. What followed was a very sharp, aggressive bounce, almost V-shaped, all the way back up to over $116,000. This type of move is often a short squeeze or a hunt for liquidity, stopping out short sellers before the true move continues. And that seems to be exactly what happened. Immediately after hitting that high, the rally completely fizzled out. Sellers stepped back in with force, and you can see a relentless series of red hourly candles dragging the price all the way back down. We ended the day hovering in the $106,000 range, a sign of extreme weakness after such a strong intraday rejection. For the short term, resistance has clearly formed between $112,000 and that rejection point at $116,000. Switching back to the daily chart, let's put this all together and outline the cases for being bullish or bearish from here. The bearish case is currently very strong. We have a clear market structure break, with the price now setting lower highs and lower lows on a macro scale. The news flow is overwhelmingly negative, with institutions pulling money out via ETFs and retail sentiment in extreme fear. Technically, the failure to reclaim levels above $115,000 is a significant sign of weakness. The most immediate danger is a decisive break and close below the $103,000 support zone. If that level fails, the psychological support at $100,000 is the next stop. A failure there could trigger another cascade of liquidations, bringing the June lows around $98,000 into play. Some analysts, citing a weekly rising wedge breakdown, are even calling for a catastrophic drop to the $52,000 area, which would represent a 50% correction from the recent highs. Now, what is the case for the bulls? Despite the grim outlook, there are a few glimmers of hope. The most significant bullish argument is that we have now successfully tested the critical $103,000 support level twice and held. This could be the formation of a powerful double bottom, a classic reversal pattern. From a sentiment perspective, extreme fear is often a contrarian indicator, suggesting that the market may be overly pessimistic and that a bottom could be near. Some analysts argue that this is a classic pre-peak pattern designed to shake out weak hands before a final euphoric blow-off top. In this scenario, this painful correction is simply a temporary detour, not the end of the bull market. For the bullish case to gain any traction, buyers need to step in and defend the $103,000 to $105,000 range with conviction. The first major sign of a real reversal would be a sustained break and reclaim of the $110,000 level. If bulls can flip that level back to support, a retest of the $116,000 rejection point would be next on the table. So to recap, here are the key takeaways and price levels to watch. The major overhead resistance remains the all-time high around $126,000. In the shorter term, sellers are defending the zone between $110,000 and $116,000. The most important level on the entire chart right now is the support zone between $103,000 and the psychological $100,000 mark. How the price reacts here will likely determine the trend for the coming weeks. Given the current momentum and sentiment, a further test of this support zone seems highly probable. I'd give it a 70% chance in the coming days. If this support breaks, the likelihood of a continued slide towards the June lows of $98,000 increases significantly, perhaps a 50% chance. A bullish reversal from this support level is less likely, but certainly possible, let's say a 30% chance. Watch for a strong daily close back above $110,000 as the first condition to reinforce that bullish possibility. Keep an eye on ETF flow data and liquidation levels, as they have been major drivers of this recent price action. That's all for today's analysis on BTCUSD. It's a critical time for the market, so trade safely out there. If you found this breakdown helpful, please hit the like button, subscribe to explain the charts, and leave a comment with your thoughts below. Finally, a quick disclaimer: this video is for informational purposes only and is not financial advice. Please do your own research before making any investment decisions.